When it comes to investing, most beginner investors eventually face this question. Should I invest steadily over time or wait for the perfect opportunity when the market drops? It's the classic standoff between dollar cost averaging and buying the dip. In this video, we're diving into both strategies, examining real-world scenarios, and breaking down the results of well-known studies. We'll even explore the psychology behind why so many investors make the wrong decisions and how to avoid them. Welcome to Mavic Finance, where we explain investing concepts in a simple way. By the way, this video does not contain any financial advice. Let's get started by explaining how dollar cost averaging works. Also known as DCA is a strategy where you invest a fixed amount of money at regular intervals, usually weekly or monthly, regardless of market conditions. For example, you might invest $500 on the first of every month into an index fund, whether the market is up, down, or flat. This method removes emotion from investing. You're not trying to guess when to get in. The key benefit is in the name, averaging. When prices are high, your $500 buys fewer shares. When prices are low, you buy more shares. It's not about timing the market, it's about time in the market. DCA is especially helpful for those who earn regular income and want to build wealth gradually. It builds discipline, removes the stress of trying to catch the bottom, and helps avoid the trap of procrastinating on investing entirely. Buying the dip takes a different approach. Instead of investing consistently, you wait for a drop, a dip in stock prices before putting your money to work. The idea is simple. Buy when stocks are on sale. It sounds smart, even logical. Who doesn't love a good discount? But here's the catch. When exactly is a dip? A 5% drop? 10%? What if prices drop and then drop even more? Or what if you wait and the market rebounds without you? Buying the dip assumes you can recognize a temporary decline and act quickly, which is much easier said than done. Even professional investors struggle with timing the market. History shows markets tend to go up over time, so waiting for the perfect moment can often mean missing the ride entirely. Let's first look at a fictional example to compare both strategies in action. Meet Alex and Jordan. Both have $6,000 to invest over the course of 1 year. Alex uses dollar cost averaging, investing $500 on the first of every month, so 12 contributions. Jordan decides to buy the dip. He holds his $6,000 in cash and waits for a market correction of at least 10% before investing. Now imagine that in this fictional year, the market has a bad first quarter, dropping 8%. Jordan thinks the market will drop even more, so he still holds his cash. Then, there is a good employment or inflation report, and the market quickly rebounds and trends upward, nothing quite reaching Jordan's 10% goal. He is obviously frustrated and his money is still not working. On the other hand, Alex steadily invests through the ups and downs, buying more when prices are low and less when prices rise. By year end, Alex is fully invested and has captured the average growth of the year. Even in a scenario where the market dropped 10% in the middle of the year, timing it perfectly to invest at the bottom is nearly impossible. If Jordan gets in too late, he loses the advantage. If he gets in too early and the dip worsens, he may not have enough cash to average. While dip buying can theoretically outperform, it rarely does in practice. To truly understand how different investment strategies play out over time, let's look at a fascinating study from Charles Schwab. They tracked the hypothetical performance of 5 investors over a 20-year period from 2003 to 2022. Each investor received $2,000 annually and chose a different method to invest it in the stock market, specifically the S&P 500. Peter Perfect was the dream investor. He had the superpower of timing the market perfectly each year, always investing his $2,000 at the lowest point of the market. His reward? More than $138,000 after 20 years. Ashley Action invested her $2,000 on the very first trading day of each year, without overthinking it. Her results? more than $127,000, just around $10,500 less than Peter, despite never timing a single dip. Matthew Monthly used dollar-cost averaging. He split his $2,000 into 12 equal monthly contributions. This method earned him more than $124,000, very close to Ashley's results, proving the power of staying consistent and removing emotion from the process. Rosie Rotten had the worst timing imaginable, always investing at the market's yearly peak. Even then, she ended up with $121,000, better than you might expect, thanks to simply being invested. Larry Linger, the procrastinator, stayed in cash, waiting endlessly for the perfect time. He finished with just 44,130 As. Over the long term, investing everything up front, known as lump sum investing, often delivers the best results. In Schwab's 20-year analysis, this strategy performed well because the money had more time to grow in the market. However, dollar-cost averaging also ranked highly, securing third place by balancing consistency with the benefit of averaging out purchase prices over time. In contrast, trying to buy the dip often underperforms because successfully timing the market is extremely difficult, and missed opportunities can drag down overall returns. Now, it's important to note, this isn't a black and white decision. Following a dollar-cost averaging approach doesn't mean you're forbidden from ever taking advantage of a market dip. In fact, many long-term investors stick to a DCA plan for discipline and consistency, but also keep a little cash on hand to deploy during significant market drops. The key is to avoid waiting endlessly for those moments. Dollar-cost averaging aligns with human psychology. It removes decision-making pressure and avoids the anxiety of trying to predict the future. It's easy to say, "I'll buy when the market drops." But when that drop comes, panic often replaces logic. Instead of buying, people freeze, or worse, they sell. Even legendary investor Warren Buffett has claimed this idea. He said that for the vast majority of people, the smartest thing to do is consistently invest in a low-cost index fund. The truth is, your mindset is just as important as your strategy. If you found this helpful, hit the like button and consider subscribing for more investing videos like this. Let me know in the comments. Have you ever tried to buy the dip, or how is your DCA going? If you like this video, you will probably like this one as well. Thanks for watching and see you very soon. Bye.